Hey there, Sonia Bersani here with Legend Lending. Today I'm going to talk to you about escrow accounts, how they work, and what you can expect at closing when you're buying a home and beyond that when you're a homeowner. So first, let's start off with what an escrow account is. Think of an escrow account like a non-interest bearing savings account. It's really an account that the lender holds on your behalf to collect taxes and insurances through monthly payments so that in the future your tax and insurance bills can be paid. Escrow accounts are calculated, quite frankly, pretty easily. We just take the annual tax bill, the annual insurance bill, and divide those premiums into 12ths. So every month you're putting in 1/12 of the annual premium. This way, over the course of a year, you save up enough money to pay those bills out when they come due. Whether or not you're required to have an escrow account will depend on the type of loan you're doing and maybe even the lender that you're working with. Normally, you need 20% down to have the ability to waive your taxes and insurances. You should also know that if you decide to pay your own taxes and insurances, most lenders are going to actually charge you a little bit of a premium up front, and it could be an upfront expense or an adjustment to the rate for the right for you to pay your own taxes. You might be wondering why that is. Why would a lender charge you to pay your own taxes? Well, everything comes back to risk, and the truth is, if taxes are not paid, they can actually take a first lien position above a lender. So to them, that's a risk that they're going to incur if they bank on you paying your taxes on your own. Each year, the taxes for that current year, the bill for that current year comes out in about October. The seller has until essentially January to pay that bill, but just know that the bill comes out and the taxes are known for that year in October of that year. So if you're closing before that tax bill has come out in the year, so if you're closing in between January and October, a lender is going to go off of the prior year's tax bill. So will the title company. Now, lenders at their own discretion, they can over adjust your escrow account to hedge for future possible tax bills. As an example, if the assessment is out, a lot of times what I'll do for my clients is base my tax collection on future assessment because we want to be over padded, not under. That's when you get those nasty letters saying that your escrow account isn't sufficiently funded. You're closing in March. Well, if you're closing in March, your first mortgage payment isn't going to be until May. Now, you don't technically skip April. A lot of people think you skip your first mortgage payment. You're really just paying it the next month. Your mortgages are always paid in arrears. Math on that. So if your taxes are $6,000 a year, that's $500 a month. So if my first mortgage payment is going to be in May, let's do the math. My tax bill's coming up in January, right? So my first payment's May, June, July, August, September, October, November, December. So we have 8 months that we're going to contribute to our escrow account. And every month we're putting in 1/12 of that premium, which is $500 a month if the taxes are $6,000 a year, right? So let's just do that math real quick. So you're making 8 payments times $500, right? So you're going to put $4,000 into escrow over the course of time that you'll have that mortgage, okay? But at closing, we have to adjust for the fact that the bill come January is going to be $6,000, not $4,000. So we're going to have to make an additional deposit at closing into escrow of at least another $2,000. Escrow deposit, okay? So this way you have your full $6,000 by the time the bill comes due. The seller is going to give you a credit for any amount of time that they've been in the property. So again, if you're closing in March and the seller had been there from January 1 to the end of March, let's say, well, they're going to give you back 3 months of escrow money. So at closing, you can expect 3 months of tax money. So that's $1,500, right? So that $1,500 is going to be a bottom line adjustment for you. So although we're collecting $6,000 in total between your future payments and what we put in an escrow, you will have gotten a credit from the seller, okay? So insurance is another piece of what goes into your escrow account. Now, insurance is a little different. Insurance is paid forward, so you pay for a full year ahead of yourself when you go to the closing table. If you ever sell the property, you would of course be refunded any unused portion of your premium, but it is paid out in advance a full year. A lot of folks wonder, well, why am I paying an additional monthly premium for insurance into my escrow if I've already paid out for the full year? Well, technically the monthly payment that you're making is really just going into that escrow or savings account to save up for next year's bill. So you're always paid out a full year. So again, just some simple math. If your insurance premium is, I don't know, we'll keep our math easy and say $1,000 a year. Well, at closing, you're going to bring your full year of insurance, and then you're going to put in at least 1 month of insurance money. And why? It's because, remember when we talked about skipping that first payment? Well, if you're closing in March and your policy is effective starting in March, by the time the next March comes around, you'll only technically have made 11 payments, right? Because you skipped that first payment. So we're going to need to supplement by collecting at least 1 month of escrow at closing, right? So that's for escrow. Okay, so you're going to have your full year plus at least 1 month. The thing about escrow accounts I want you to know is that lenders are allowed to keep a little bit extra in there. There's actually a limit on how much they can keep, and it's 2 months worth. So they can't hold more than 2 months of a surplus in your escrow account at any given time. If it is, they have to cut you a refund back for any overage they have. Most lenders are going to opt to close with at least that 1 or 2 month of cushion, and that's really not a bad thing because it's just hedging you in case your future tax bills go up or your insurance goes up. When you are a homeowner, you've closed and you're in the house and now you're responsible for it on your own, the escrow account can be a really great thing just to kind of handle the taxes and insurances for you, but you shouldn't ignore the notices you get. Every year around March or April, you're going to get a notice of assessment, and that comes from the appraisal district, and it's basically telling you if your taxable basis is going up. You have a period of time to appeal that, so whether or not you do could impact what your tax bill is going to be that following October. To give you an example, if you get a notice one year that your assessment is going up pretty dramatically and maybe you haven't filed your homestead exemption, well, guess what? The mortgage company, they only analyze escrow accounts maybe once a year or twice a year. So they may not even know about that increase until 6 months down the road when the bill comes out. Problem with that is they will not have collected enough for that bill because they didn't know about that yet. There's no harm in you contacting the lender and saying, hey, I got a notice, my assessment's going up to this. Should we analyze my escrow now? Are there any adjustments to be made so that I don't get hit later on? With all this being said, there's a lot of good and bad about having an escrow account. I've done both myself. I've escrowed and not escrowed. I personally prefer to escrow because it really kind of does run itself. I don't have to worry about stroking the check once a year. It's just in my payment each month and it's already budgeted for. But I do still watch out for those notices to make sure it's being properly funded. Some folks are not a fan of escrowing, and that's okay too. You just need to make sure you're budgeting appropriately and that you know what to expect when the bills come due. Check out the description below. I include a lot of helpful links. They're all to the appraisal districts in different counties throughout Texas, as well as a homestead exemption calculator that's really neat because you can see how much a homestead exemption might actually save you on your tax bill. So all that's in the description below. I hope this is helpful for you. And of course, if my team or I can ever help you, we're here for you. Take care.